Welcome to video 5 of part 2 of the EA Tax Training free EA exam prep course for 2026. Tom here, back with you to discuss sole proprietorships and partnerships. Up until now, we've been talking about things that affect all businesses, such as income, expenses, asset basis, etc. But in these next few videos, we're going to get into the specifics of each different type of taxable entity, obviously starting with this one, covering sole proprietorships and partnerships. Our free resources from irs.gov, only 4 in total, but they are in bold. We've got 2 for sole proprietorships and 2 for partnerships. For sole proprietorships, we've got Schedule C of Form 1040, along with its instructions, and IRS Publication 334, Tax Guide for Small Business. For partnerships, we've got Form 1065 and its instructions, along with Publication 541. So let's get started by discussing sole proprietorships. What we'll cover is an overview of Schedule C, then we'll talk about owner's pay, self-employment tax, health insurance for the sole proprietor, retirement, and then automobile expenses. As a recap, remember a sole proprietorship is when one person goes into business. They don't have to formally do anything with the Secretary of State's office. They can just start business. If they do get a single member LLC, the default will be that it will be a disregarded entity and will be taxed as a sole proprietor. Of course, that LLC could elect to be taxed as a corporation, but if they file nothing with the IRS, automatically a sole proprietor. Sole proprietors file on Schedule C of Form 1040, so there's no separate tax return. And it includes a qualified joint venture. Remember, that's when you've got spouses who are technically in a partnership, but they can file as if they were sole proprietors. Each spouse files their own separate Schedule C and Schedule SE. And if a taxpayer has more than one business, then each business should have its own separate Schedule C. And the income from the business, of course, flows to Form 1040 because that's where it's reported on Schedule C of 1040, and the income is taxed at the normal individual tax rates. So let's take a look here at Schedule C. So at the top, you're going to have the basic information, including that NAICS code and the employer identification number if there is one. Business name, you can leave blank if you're just doing business as yourself. If you've got a separate business name, then you would put that here, and then you would put your business address. Check your accounting method. Most sole proprietors use cash, but you don't have to. And then there's some other check boxes that you'll see here. Then we move down to income. We've seen this before. And then part 2 covers expenses. So you're just going to fill in any of these expenses that you have. Most people aren't going to have all of them, but fill in the ones that you have. If you've got expenses that are not listed here, which most people will, then you'll put those on other expenses, and we'll see on the next page where there's a place where you can list out those other expenses. That'll come down to your total expenses. It does have a separate place to put your home office deduction, and you'll come down to your net profit, and then it reminds you of a few other things, including Schedule SE. Then we'll move on to page 2. Part 3 of the form is for cost of goods sold, so you will check the method you were using. Most people will use the cost method. Was there a change? If you say yes, of course, you should have a Form 3115 attached. Then we get into our calculation of cost of goods sold. So remember, we start with beginning inventory, we add purchases, we subtract out ending inventory. So this is just detailing out all of that, and that will end then with your final cost of goods sold. Then part 4 is information on your vehicle. If you are claiming expenses for a vehicle, there is this information you need to put in here, including all of your mileage. Answer some questions. We'll be talking about automobile expenses in this video. And then finally, part 5, this is where you list out those other expenses from your P&L on the first page. Moving on to owner's pay. So how does a sole proprietor get paid? Well, they do not use payroll. Even if they have other employees, so they're running payroll, the owner does not get a salary. Instead, the owner takes their pay, by making withdrawals from the business bank account. And the taxable income is not dependent on the amount of those draws. It's dependent on the profit or loss of the business, which could be more or less than the amount drawn. So you're going to have there on Schedule C your income, your expenses. The net profit is what you're going to pay tax on, regardless of how much you actually draw out of the business. Then remember, there is self-employment tax. We did talk about this back in Part 1 as well as in Part 2. This is reported on Schedule SE. As a reminder, up to $176,100 of net earnings from self-employment are subject to the Social Security piece of the self-employment tax. That's the 12.4%. There is no cap on the amount subject to the Medicare tax. That's the 2.9%. And of course, half of that self-employment tax is an adjustment to income on Schedule 1 of the 1040. So you do get to deduct half of it. That represents the employer's share of Social Security and Medicare tax. So to revisit our calculation, when we say net earnings from self-employment, what that means is your profit and loss from Schedule C times 92.35%. So for example, Leo has a Schedule C business with $60,000 of revenue and $23,000 of expenses. So his profit on his Schedule C is $37,000. His net earnings from self-employment, though, are $37,000 times 0.9235, which is $34,170. So he will owe self-employment tax of $34,170 times 15.3%, which is $5,228. Why are we multiplying it by 92.35%? So the employer's half, remember, is 7.65%. So 1 minus 7.65% is 92.35%. If this were not a sole proprietorship, let's say it was an S Corp, the employer's share of Social Security and Medicare would be 7.65%, and that would be a deduction on the S Corp's tax return. Because it's a sole proprietorship, we don't have salary. We're not deducting that employer's share on Schedule C. So multiplying by 92.35% makes up for that. In any case, this is how you do the calculation. You should know how to do that for the exam. Owner's health insurance. Premiums paid for the owner's health insurance and other fringe benefits are not deductible on Schedule C. However, self-employed health insurance premiums may be deductible as an adjustment to income, as we saw back in Part 1. In addition, limited amounts of long-term care insurance can also be included in the self-employed health insurance deduction. So as a recap, in order to qualify for the self-employed health insurance deduction, you must be self-employed and not eligible for subsidized health insurance from your or your spouse's employer. And you have to have a profit from the business in order to cover the deduction. So if you only have a $5,000 profit from the business, then you can only take up to a $5,000 self-employed health insurance deduction. Another way a sole proprietor can get health insurance is if their spouse is an employee of the business, so they're on payroll. Then if the business offers health insurance to their employees, the spouse is an employee, so the spouse can buy a policy in their name, and then the owner gets coverage as the spouse of the insured. So if you've got other employees anyway that you're offering health insurance and your spouse is working in the business, this is a way you can hire the spouse. Spouse gets health insurance, names you as their spouse, and so you get coverage that way. It's another way to go about having deductible health insurance. For retirement, contributions to SEP, simple and qualified plans for the owner are not going to be reflected on Schedule C. However, they are deductible as an adjustment to income on the 1040, as we saw back in Part 1. For the SEP, the self-employed pension, the owner can contribute up to 25% of their net earnings from self-employment, up to a maximum of $70,000 for 2025. You can establish the plan with a simple one-page form at a bank or financial institution. For a simple IRA, the Savings Incentive Match Plan for employees, you can contribute all of your net earnings from self-employment up to $16,500, plus if you're age 50 or older, an additional $3,500, which would be a total of $20,000. So numbers to know: if you're under age 50, the maximum for a simple IRA, $16,500. If you're age 50 or older, maximum is $20,000. And then, new for 2025, if you are age 60 to 63, instead of an additional $3,500, you can contribute an additional $5,250, making the total $21,750. You do need to set up the simple IRA by October 1st of the year, unless you became self-employed after October 1st, in which case you set it up as soon as administratively feasible. Next is a 401k plan if you have an employer. So if you got a side business, or if you start the business partway through the year, you can contribute to an employer plan as normal. So that's $23,500 a year, up to an additional $7,500 if you're age 50 or older, for total contribution of $31,000. Again, if you're age 60 to 63, we got this super catch-up contribution. So instead of $7,500, you can contribute an additional $11,250 for that total of $34,750. In addition to that, if you've got your own 401k for your business, you can contribute an additional 25% of your net earnings from self-employment, up to a total of $70,000. The $70,000 includes the amount you contribute, quote unquote, as an employee, even though you're not on payroll, and the amount that you contribute because you are the owner of the business. If you don't have any employees other than you and your spouse, then you can also set up a solo 401k plan. Again, you can contribute as an employee the same amounts, the $23,500, the $31,000 if you're 50 or older, the $34,750 if you are age 60 to 63. And then you can also, as the employer, contribute up to 20% of your net earnings from self-employment, up to $70,000 total, or if you're age 50 or older, up to $77,500. There are other types of retirement plans that we'll talk about in video 9, but these are usually not used by sole proprietors. But you've got profit sharing plans, money purchase plans, and defined benefit plans. And our last topic for sole proprietorships are automobile expenses. These are a very common expense for sole proprietorships. You can deduct the business use of an automobile. To do so, you're going to choose one of two different methods, either the standard mileage method or the actual expenses method. No matter which method you choose, you do have to keep track of your mileage. You remember back there on Schedule C on the second page where it had the automobile information, you have to put your business, your personal, and your total miles. So you can keep track however you want. You can do it with pen and paper. There are apps that will help you do it. But in order to deduct your automobile expenses, you need to be tracking your mileage. For the standard mileage method, you can simply take 70 cents per business mile. So it's pretty easy. Add up your business miles, multiply by 70 cents. That is your deduction. That 70 cents includes depreciation, lease payments if you have any, maintenance, fuel, insurance, and vehicle registration fees. There are some things it does not include, which is interest expense if you have a loan, personal property taxes on the vehicle, and the parking fees and tolls that you may pay. So the business portion of those items can also be deducted in addition to the 70 cents per mile. I have parking fees and tolls because it seems like they like to ask questions about this. So they may give you a question, for example, that says the standard mileage deduction includes all of these expenses except, and they'll have listed out maybe depreciation, fuel, insurance, and then they'll have tolls. And so you need to be able to pick out tolls from that list or parking fees from that list. And then also we said you can deduct the business portion of those. Well, if that is interest expense on an auto loan, then you're going to just take your mileage. So your business miles divided by your total mileage, that's your business use percentage. So you can deduct that much of your car loan interest. Same way with personal property taxes. Parking fees and tolls, though, usually those are either going to be 100% business or 100% personal. So if you go to a business meeting, you have to pay to park, you can deduct the entire parking fee because it was for business. If you're on your way to a business meeting and you have to pay tolls, then you can deduct 100% of those tolls. On the other hand, if you're just driving personally and you have tolls, 0% of those tolls would be deductible because it has nothing to do with business. So you just need to think, is this business or not? If it's 100% business, deduct 100% of it. If it's 100% personal, deduct 0% of it when it comes to parking and tolls. If you do want to use the standard mileage method, it must be chosen in the first year the vehicle is placed into service in the business. Then in subsequent years, you can choose either to use the standard mileage method or the actual expenses method. So first year, you have to use standard mileage if you ever want to use the standard mileage method. After the first year, then you can decide each year which one gives you the higher deduction, and you can take that one if you want to. And then they do have this rule that you cannot use the standard mileage method if you are operating 5 or more vehicles. So if you have a fleet of vehicles, you're going to have to go to the actual expense method for those. So let's talk about the actual expense method. For this method, you can deduct the business portion of depreciation, repairs and maintenance, tires, license and registration fees, gas, oil, tolls, lease payments, auto interest, insurance, and parking fees. Again, the business use is going to be based on your business miles divided by the total miles driven during the year. And if you choose the actual expense method in the first year the vehicle is placed in service, then you must use it for all of the subsequent years. So one of those expenses that you get to take is depreciation, but depreciation on automobiles is subject to special limits. These are called the Section 280F luxury auto limits. So whether or not you think your vehicle is a luxury auto, you still have to follow these limits. So you're going to figure out your depreciation. We'll talk about how you do that on the next slide. But when you figure out your depreciation, these dollar amounts are the maximum you can take each year for that vehicle. In the first year, if you are taking bonus depreciation, that special depreciation allowance, the maximum you can take is $20,200. If you're not taking bonus depreciation, the maximum depreciation you can take in year one is $12,200. And then you can see in year two, the maximum you can take is $19,600. Year three, it's $11,800. In year four and beyond, it's $7,060. Now you can keep taking depreciation each year until you have fully depreciated the vehicle. So we're going to see in the next slide, automobiles are 5-year property. But because you have annual limits, when you get to the end of 5 or 6 years, you may not have actually depreciated the whole vehicle. So what this is saying is you can keep on going. You can go year 6, year 7, year 8. The maximum you can take each year is going to be $7,060, but you can keep going till you have fully depreciated the vehicle. You can also take Section 179 on the vehicle, but you do not get this increased first year limit for 179. That's only for bonus depreciation. If you're taking 179, you are still limited to $12,200 in the first year. So let's talk about how you calculate the depreciation for your automobile. So an automobile is considered listed property, and so therefore there are some special rules. Because it is listed property, you can only use accelerated depreciation if business use of the automobile is greater than 50%. So you keep your mileage. How much is business? If that percentage is under 50%, you cannot use accelerated depreciation. You're going to have to use straight line depreciation. That also applies to both bonus depreciation and 179. If your business use is under 50%, you cannot take either of those. If your business use is greater than 50%, then you can use bonus depreciation, you can use Section 179, and you can use accelerated depreciation, which for a 5-year asset is double declining balance. also called 200% declining balance. But remember, you still have those limits that we just talked about on the previous slide. So if it's greater than 50%, you can use bonus depreciation, 179, accelerated depreciation, but you have those maximums each year to keep in mind. If it's less than 50%, then you are going to automatically have to use the alternative depreciation system, which means straight line depreciation over 5 years. If all of that seems complicated, and it is a bit complicated, you can just skip this and use the standard mileage method. Just use the 70 cents per mile. You don't have to worry about all of this. But there can be times when you can get a lot more deduction by using the actual expenses. So if you want to use the actual expenses, this is how you do it. And you should understand the general concept for the exam. Then also, let's talk about other listed property just for a minute since we're here. You can see other listed property includes computers, aircraft, other types of vehicles, and entertainment property such as cameras and communication equipment. So they've got the same basic rule. If your business use is not greater than 50%, you cannot use any type of accelerated depreciation. You have to use straight line depreciation. If it's greater than 50%, you can use the regular maker's depreciation and or bonus or section 179 depreciation. Moving on now to partnerships. Before we start our discussion of partnerships, we need to have a little conversation. Partnerships can be very complex. It is commonly accepted throughout the income tax world that partnerships are the most complex of all the different types of business entities. More complex than C Corps, more complex than S Corps, certainly more complex than sole proprietorships. There are CPAs and attorneys who specialize in just doing partnership taxation. That is all they do. Now, usually they're working for large firms, which are dealing with large partnerships. But that's one of the things that can make partnerships so complicated. You can have hundreds, even thousands of partners. You can also have all different kinds of partners, individuals, C corporations, S corporations, other partnerships can be partners in a partnership, trusts, estates. It can get to be overwhelming. So that's the bad news. The good news is on the EA exam, they're going to keep it simple. You're not going to have to deal with hundreds and thousands of partners. Other than conceptually, you're not going to have to deal with having other partnerships as partners and trusts and estates and all of that. The questions will be fairly straightforward. We'll show you the kinds of things that you'll need to know for the exam here in this video. In the real world, if you have someone bring you a partnership, before you commit to anything, you want to look at the facts and see what's going on. If it's fairly simple, it's just two guys open to business, then it's probably no problem. But if you've got one of these that's got multiple partners, trusts, estates, S corps, they've got some partners coming in, some partners leaving, partners contributing all kinds of different property, getting distributions of all kinds of different property, you're going to have to decide whether or not you feel comfortable preparing that return. And if you don't, no shame in saying, hey, look, partnerships are not my specialty. Let me refer you to someone who can help you. But again, for the EA exam, don't panic. They just want to test that you understand the basic concepts. So that's what we are going to go over. Specifically, what we are going to cover are partnerships in general and Form 1065, partners pay, profits, losses, and separately stated items. Then we're going to talk about basis, both inside basis and outside basis. Then contributions to and distributions from a partnership. Then a disposition of a partnership interest. Then we're going to talk about some schedules, Schedule K, K1, K2, and K3, along with Schedule L, M1, M2, and M3. And then we'll finish up with some miscellaneous partnership topics. As a reminder and overview, a partnership is when two or more people and or entities go into business without incorporating. It is also the default for a multi-member LLC if they don't elect to be taxed as a C Corp or an S Corp, as well as a limited liability partnership or a limited partnership. The partnership itself generally does not pay tax. There are a couple of exceptions to that, but in general, it doesn't pay tax. It is a pass-through entity so that the profits and losses pass through to the partners. And then those partners are taxed on their tax returns for the income from the partnership. And then if you are just investing, such as you are just buying a piece of real estate to rent out, you can generally elect to not be treated as a partnership. So for instance, if it's two individuals, they own this rental house together, they can just split the income and expenses on their own Schedule E on their personal tax returns. They don't have to file a Form 1065. But if you are in business, investing is not considered a trade or business. So if you are in business, then you do need to file the Form 1065. As we go throughout the rest of this video, for simplicity's sake, I will usually speak of the partners in the partnership as if they were individual taxpayers, individual human beings. It just makes it easier to talk about and to think about. It's also more relevant to what you are likely to see on the EA exam. But just keep in mind, just about anyone can be a partner in a partnership. A C Corp, an S Corp, another partnership, an estate, a trust, any of them can be a partner. And it works the same general way. It's all pass through income from the partnership gets reported on that entity's separate tax return. So it's all the same concepts. It just makes it a lot more complicated to think about. So we're going to assume that they are individual taxpayers unless we say otherwise. So let's look at the front page of the Form 1065. So we're going to start here at the very top, and right away we're going to start talking about what if you have an entity that is not an individual. So here you can see it says for calendar year 2025 or tax year beginning, fill in the blank for the date it began and fill in the blank for the date it ended. If you do have individuals as the partners, then of course they are on a calendar year and you can ignore this. But remember when we talked about back in video 1 about partnerships, we talked about tax years, we said they have to have the tax year of the majority of their partners. So if you've got a C Corp that is a greater than 50% partner in this partnership, and that C Corp has a different year end, such as September 30th, then this partnership has to have a September 30th year end. So you would say beginning October 1st of 2025, ending September 30th of 2026. That would be the 2025 tax return. So when you're trying to figure out what year is it, it's the year that the tax year begins. So for a calendar year, the tax year begins on January 1st of 2025. So it's a 2025 tax return. Well, it doesn't matter which month in 2025 your tax year starts, whether it starts February 1st, March 1st, April 1st, whatever. If it starts in 2025, even if it starts in December, if it's December 1st, 2025, that's when your 2025 tax year begins. You will use the 2025 tax form. So in any case, fill this in as appropriate. If it is a calendar year, you can just leave it blank. Then you're going to fill in all the basic information about the partnership. You can see you've got check boxes here, pick your accounting method, some other information to fill out. Then we go down to the income, which we have seen before. Then you have the deductions. So you're going to list out your deductions. You do have that other deductions again, like we saw on Schedule C. However, here there is not a place on the 1065 itself to list out those other deductions. Instead, you will attach a statement to the tax return showing those other deductions. Then that's going to come down to your ordinary business income. So we are going to be talking a lot about ordinary business income versus separately stated items. So this is that ordinary business income. The income and the expenses directly attributable to the partnership that are not being separately stated out to the partners on their K1. So ordinary business income. Then you're going to have some amounts that can actually be owed by the partnership itself. So again, usually the partnership is not paying any taxes, but you have these circumstances where they can. So you would show those amounts here. and then you have your signature blocks. We will look at some of the other parts of the 1065 a little later in this video. The filing deadline for the 1065, as you will remember, is the 15th day of the third month following the end of the tax year. So that is March 15th for a calendar year partnership. Note that for the 2025 return, March 15th to 26 was on a Sunday, so the due date was March 16th of 2026. You might get questioned on that. Seems like they like to ask these types of questions, so you want to keep that in mind. And you can request a 6-month extension to file the partnership return by filing Form 7004. Penalties for late filing, it's $255 per partner per month or part of a month. You'll remember when we talked about the 1040, the penalty for the 1040 is based on the amount due with the tax return. And we said if you don't have an amount due, then you don't have a late filing penalty. Well, with a partnership, they're usually not going to have an amount due, so that wouldn't make any sense. So instead, what they do is they have this flat amount per partner per month or part of a month. So it's $255 per month, but you have to have at least two people to make a partnership. So you're going to have at least two partners. So you're talking about a minimum $510 per month or part of a month as the late filing penalty. There's also a separate penalty for failure to furnish an information return, meaning the K1 or the K3 that we'll be talking about. But that is $340 each, unless it's intentional. If it's intentional, it doubles to $680 each. And you can see here the maximum total penalties are quite large. So even at $340 a piece, if you've got thousands of partners, these amounts can really add up. So the maximum penalty you can see there is over $4 million for partnerships with gross receipts of over $5 million. And it's over $1.3 million for entities with gross receipts of under $5 million. But the point is, these can really add up if you're not filing those Schedule K1s. If your failure to file is intentional, then it does increase, as we said, to $680 each, up to a maximum of 10% of the aggregate amount of items required to be reported with no limits. So if you've got thousands of K1s that are each reporting income, you have to add up how much income are they reporting, multiply that by 10%. That's your penalty for willfully failing to file those K1s. So the IRS is not playing around here with these late filing penalties. Now let's talk about partner pay and pass-through items. So how do partners who work in the partnership get paid? Partners who are active in the business are compensated with cash payments, but they are not considered payroll. So just like a sole proprietorship, partners who work in the business are not on payroll, and therefore they are not subject to the typical payroll taxes and withholding. Instead, what they get are something called guaranteed payments. They are guaranteed in the sense that they are made whether or not the partnership is profitable. So this differs from distributions to the partners based on profits. So if you are, for instance, a 50% partner in the partnership, then you're going to report half of the profits from the partnership. But if you work in the business, not only are you going to report half of the profits, you're also going to report whatever guaranteed payments you got for working in the business. So these guaranteed payments are replacing a salary. Since you're not on payroll, you're just getting cash payments instead for the work that you do for the partnership. In addition to that, you'll be reporting your share of the profits from the partnership. From the partnership standpoint, guaranteed payments are treated as if they were paid to a third party, which means they are deductible. So the partnership actually gets to deduct the amounts they pay to the partners for working in the partnership, just like they would get to deduct salary. So it's the same idea. And then, of course, those guaranteed payments are taxable to the partner who receives them. Guaranteed payments can be for services rendered, as we've been talking about, but they can also be for the use of capital. So usually when we talk about guaranteed payments, we think of it as for services that are rendered. And when we talk about guaranteed payments in this video, that's what you should assume. But just know that a partner can also get them for use of capital. So it could be, in effect, a loan to the partnership. Instead of interest, they would get guaranteed payments. Or it could be for the use of other property. So those would be capital payments. Also, premiums paid for health insurance by the partnership on behalf of the partner, as well as other fringe benefits. So most fringe benefits that a partnership provides for the partner are taxable to the partner. So they will also be treated as guaranteed payments. The guaranteed payments that the partner receives are considered self-employment income. They will be reported to the partner on their K1. So they'll get a K1 that shows their percentage of all the profits and losses from the partnership. It will also show the amount of their guaranteed payments. And then the partners must file Schedule SE on their 1040 and pay self-employment tax. And they pay self-employment tax on both their guaranteed payments and their share of ordinary business income. All partners pay self-employment tax on guaranteed payments for services, and all general partners pay self-employment tax on their share of business income from the partnership. So again, as we said back in video 1, think of a partnership as just an extension of a sole proprietorship. Instead of having just one person, you've got 2 or more people. So they're going to do things much like a sole proprietor does. They're not going to take a salary, and they're going to report the amounts that they get on a Schedule SE. And just like a sole proprietor, they can take the self-employed health insurance deduction. So they're getting those amounts as guaranteed payments for health insurance from the partnership, for example. That's included in their income, but then they can take the self-employed health insurance deduction. Guaranteed payments are included in the income of the partner in the partner's tax year in which the partnership's tax year ends. So that's a tongue twister. Let's look at an example. Erica is a 10% partner and receives guaranteed payments of $10,000. The partnership has $50,000 of ordinary income, so Erica must report $15,000 of income from the partnership. Her $10,000 in guaranteed payments, plus $5,000 as her share of the profits of the partnership. And she's going to report that on her individual tax return for her tax year in which the partnership's tax year ends. So if it's a calendar year, it's easy. Her tax year and the partnership's tax year end on the same date. So if it's 2025, she's going to report it on her 2025 tax return. Let's look at another example. Lamont is a partner in a partnership with a fiscal year that ended January 31st of 2025. So this partnership's fiscal year was from February 1st of 2024 through January 31st of 2025. So he received guaranteed payments from February 1st of 2024 through December 31st of 2024. So he includes those guaranteed payments in his income on his 2025 tax return. So this is another exception to the cash method of accounting for him as an individual. As an individual, normally he received the amounts in 2024, he would include them in income in 2024. But because it is a guaranteed payment from a partnership, it's different. He's not even going to receive the K1 for that partnership until when? Well, it's due April 15th. It's the 15th day of the third month following the end of the tax year. So the end of the tax year was January 31st of 2025. He's not going to get that K1, possibly, until April 15th of 2025 when he's already filed his personal tax return for 2024. So he would wait and include this income in his 2025 tax return. So think about the logic of when are you going to receive the K1. That clues you in to when you are going to report that income. The partner's share of profits. So the partnership agreement will spell out the percentages of profits to be allocated to each partner. Hopefully you have a written partnership agreement, but remember it's not required. But even if it's not written, there will be some sort of agreement. It might just be a handshake agreement that, hey, okay, we're 50-50 partners. So whatever that agreement is, that's how you will split the profits. And the profit percentages can be different than the capital percentages. So for instance, Abe and Ben form a partnership with Abe contributing $1,000 and Ben contributing $99,000. So that means their capital percentages or their equity percentages is 1% for Abe, 99% for Ben. But since Abe has the expertise needed to actually run the business, the partnership agreement grants him 25% of the profits, with 75% going to Ben. So Abe is only a 1% capital partner. He's only got 1% equity in the partnership, but he gets 25% of the profits. That is perfectly acceptable with a partnership. The reason this is important, because remember back in video 1, we said a very common decision point when 2 or more people are entering in business is, should we be a partnership or should we be an S corporation? This type of split is not allowed in an S corporation. If you're a 1% equity owner of the S corporation, you're going to get 1% of the profits or losses from that S corp. It cannot be different. So one of the advantages of the partnership over the S corp is you have the flexibility to have these types of arrangements. But whatever those profit and loss percentages are, the profits will flow through to the partner's separate tax returns, as we said, on a Schedule K1. So the Schedule K1 will reflect this 25-75 split in profits and losses. And remember, those profits are taxable even if little or no cash is actually distributed to the partners. And any losses can be taken on the partner's individual tax returns, assuming that they have basis in the partnership, which we will be talking about here shortly. Separately stated items. So there are some items of income and expense that are not recognized by the partnership itself. So when we looked at that 1065 and we saw that ordinary business income, some amounts of both revenue and expense are not going to be reflected in that ordinary business income. Instead, they are going to be reported separately to each partner, their share of it, on their Schedule K1. So these are called separately stated items. Some examples are portfolio income, interest, dividends, capital gains and losses. Section 179 deductions. They will not be included in depreciation expense on page 1 of the Form 1065. Charitable contributions will not be included in the expenses on page 1 of the 1065. There are others as well. Then also all of the information needed for that qualified business income deduction, W-2 wages, the unadjusted basis of assets that are used in the business, that type of information, that will also be separately stated on the K1. So let's look at an example. STL Partnership, which is owned equally by Stan and Lee, has revenue of $200,000 and operating expenses of $125,000. So that's their ordinary business income and expenses. They also have $20,000 of Section 179 expense and $2,000 of charitable contributions, which of course are not included in their operating expenses. So their business income shown on page 1 of Form 1065 is $75,000. In addition, Stan and Lee will each be allocated $10,000 of Section 179 expense and $1,000 of charitable contributions for possible deduction on their Form 1040s. It's possible deduction because obviously they may or not, for instance, itemize deductions. If they don't itemize deductions, they're not taking that charitable contribution. So maybe one of them does itemize, the other does not itemize. So one will take that charitable contribution deduction, the other will not. And then Section 179 also is going to depend on the taxpayer, whether or not they can take it. That's going to be especially relevant for example, large corporations who are partners in a partnership. You'll remember Section 179 has limits. So they may have already reached their limit, or they might be a very large business, so they can't even take any 179. So it will be reported separately for each partner to take that expense if they are able to do so on their return. Related party transactions. A partnership cannot deduct a loss on the sale of property to a related party. So again, the IRS does not want taxpayers manufacturing tax losses by selling property back and forth to each other. So if the partnership sells property to a related party and has a loss, there is no deduction for that. So who is a related party? Well, a related party includes any partner with a direct or indirect ownership of more than 50% of the capital or profits, either one. It also includes another partnership or an S Corp if the same person owns more than 50% of each, and any family members. So you may have multiple entities. Maybe you've got an S Corp and you got a partnership. Well, if your partnership sells an asset to your S Corp at a loss, can't deduct the loss. Or if your partnership sells you as a partner an asset at a loss, can't deduct the loss. Same applies for any of your family members. And when they say family members, this is what they mean: siblings, half siblings, your spouse, parents, grandparents, children, grandchildren. All of those would be considered family members and related parties. And also notice this: directly or indirectly. You see that sometimes in the tax law. So, what that might be, for example, you could have a partnership that has individuals as partners and trusts as partners. So, maybe an individual owns, let's say, 30% of a partnership. They are a 30% partner. But then they also have a trust. They're the beneficiary of this trust. The trust also owns 30% of the partnership. They are a 30% partner. Well, that means that individual effectively is a 60% partner in the partnership. That is, their indirect ownership is 60%. So they are a greater than 50% partner when you're looking at these related party rules. Then we're going to be talking about basis next, but we have this point down here that even though this loss is not deductible by the partnership, it does still decrease the basis of the partners. So it's a non-deductible loss, but it still decreases each partner's basis in the partnership. So that leads us to our discussion of basis. So, like other assets that people own, each partner will have a basis in the partnership. And when we talk about partnerships, there are actually two different types of basis that we need to think about: inside basis and outside basis. Inside basis is the partnership's basis in its assets. So every business owns assets. It has a basis in those assets, as we've talked about in previous videos. So a partnership is no different. It's going to have a basis in the assets that it owns. That is called the inside basis. The outside basis is the partner's basis in the partnership itself. So that outside basis is important because it's used to determine deductible losses that flow through from the partnership. So you get to deduct the losses that come from the partnership, but only to the extent that you have basis in that partnership. If you don't have any basis, you cannot deduct those flow through losses. We'll talk about that. It's also important to be able to calculate any gain on distributions from the partnership in excess of your basis. So if you get more money out of the partnership than you put in, that is a gain. So you need to know your basis in order to compute that. Then also you need to know your basis in case you ever sell your partnership interest. Sell your partnership interest, it's an asset. You need to compute your gain on the sale of that asset. So you're going to take the sales price, subtract your basis, that's your gain on sales. So you need to know your basis for that as well. So let's look at an example of basis here. Partner A contributes a building with a fair market value of $200,000 to form a partnership with Partner B. But Partner A's basis in that building at the time of the contribution is $100,000. So the way it works, we'll talk about contributions later, but the way it works is the basis of the asset just carries over from the partner to the partnership. So what happens is when A contributes to this building with a $100,000 basis, the partnership now steps into the shoes of A. So the partnership now has a building with a basis of $100,000. So that is the inside basis of the building. Partnership has a $100,000 building. They will now take depreciation expense based on $100,000. If they sell that building, their basis in that building is $100,000. So that's their inside basis of that building. Partner B then contributes $100,000 of cash for her share of the partnership. So the partnership uses that cash. They use $50,000 of it to buy some equipment. The rest of it they keep in the bank. So the partnership now has an inside basis in its assets of $200,000. They have a $100,000 building, they've got $50,000 worth of equipment, and they've got $50,000 worth of cash. The outside basis, again, means each partner's basis in the partnership itself. So in the previous example, each partner starts with a $100,000 basis in the partnership. Partner A put in a building with an adjusted basis of $100,000. So they've got $100,000 of basis. Partner B put in $100,000 cash. So they've got $100,000 of basis. So the total outside basis is $200,000. You'll notice that matches the inside basis. So when you have a partnership that's just starting out, the inside basis and the outside basis are going to be the same. But over time, those bases are going to change, both inside basis and outside basis, and they'll change in different amounts usually. So there can be eventually a significant difference between inside basis and outside basis. So how does basis change? Well, for inside basis, it's easy. We talked about this back in video 3. It's going to change for a partnership just like it changes for anybody else. If you make improvements to the property, that's going to increase the basis. You take depreciation expense, that's going to decrease the basis. You could have theft or damage that's not covered by insurance. So you take a deduction for that, that's going to decrease your basis. You get insurance proceeds. It's not taxable, but it's going to decrease your basis. So all the normal things that increase or decrease the basis of assets that you own will do the same thing for a partnership. So what about outside basis? Well, outside basis is increased by the following: any additional contributions that the partner makes, including an increased share of or assumption of partnership liabilities. So we'll be talking about partnership liabilities here in a minute. But the partner gets basis for their share of the partnership liabilities. So if those liabilities increase, the partner's basis in the partnership increases as well. And this does include a partner personally guaranteeing a partnership loan as long as certain criteria are met. Next thing that increases the partner's basis is their share of taxable and non-taxable income. So they're going to get that K1. It's going to report their share of the partnership's income. Whether that income is taxable or not taxable doesn't matter. It increases their basis in the partnership. And then finally, the partner's share of the excess of depletion over the basis of depletable property, unless the property is oil or gas wells whose basis has been allocated to the partners. So for the exam, just remember excess depletion increases outside basis. So then what decreases outside basis? Well, all of these things decrease it, however, never below zero. So basis can never go below zero. Remember that. But these things decrease it: money and adjusted basis of property distributed to the partner. So you make a contribution of property, you get an increase in basis. You take a distribution of property or cash, you have a decrease in basis. And this includes a decrease in the partner's share of liabilities. The next thing that decreases basis is the partner's share of partnership losses. So their share of income increases basis, their share of losses decreases basis. That also includes the partner's share of non-deductible partnership expenses. So one example would be that loss on the sale of property to a related party. Remember, that is not deductible. It still does, though, decrease your basis. But also things like 179. That'll be separately stated. But if the partner can't use the 179 deduction, doesn't matter. It still decreases their basis. Or that charitable contribution. If the partner can't take the charitable contribution deduction on their tax return, doesn't matter. It still decreases their basis in the partnership. Then next, we have more depletion. So the partner's deduction for depletion for oil and gas wells up to the proportionate share of their adjusted basis of the wells allocated to the partner. So remember, oil and gas depletion decreases the partner's basis. Then the partner's share of foreign taxes paid by the partnership decreases their basis, and the partner's share of the adjusted basis of any property that the partnership donates to charity also decreases the partner's basis. So, most of the time, we're going to be talking about distributions from the partnership, and we're going to be talking about losses and deductions, taxable and non taxable losses and deductions that come from the partnership. That's what decreases basis. Now, let's talk about those partnership liabilities. A partner's basis, their outside basis in the partnership, includes the partner's share of a partnership liability only if and to the extent that one of the following applies. First of all, it creates or increases the partnership's basis in any of its assets, including cash. So if the partnership gets a $10,000 loan from the bank, they now have cash of $10,000. So they've got basis in that cash of $10,000. So that counts. That loan increases the partner's basis in the partnership. Or if the liability gives rise to a current deduction to the partnership. So this would be, for example, trade accounts payable for an accrual basis partnership. So you're on the accrual basis. You buy something, a product or service, you don't pay for it right away. Of course, you're going to deduct it right away as soon as you incur that expense. But now you have an account payable on your balance sheet. You have a liability on your balance sheet. You owe that vendor for performing that service or providing that product. So you get basis for that liability, for that account payable. Then the third way you can have basis from the liability is if you have an accounts payable for a non-deductible expense. So remember, not all expenses are deductible for tax purposes. So if, for example, the partnership is paying for country club dues, not deductible, but if they incur those dues, haven't paid it yet, they have an account payable for that. That is a liability. Partner gets basis for their share of that liability as long as they are on the accrual method of accounting. Which leads us to our next point is accrued expenses and accounts payable do not affect basis for a cash basis partnership. Why not? Well, this is another example where we're trying to put cash basis and accrual basis partnerships on the same footing. So let's go back to that accounts payable if you are on the accrual basis. Let's say the firm has some legal work done. The attorney sends them an invoice for the legal work. They're on the accrual basis. They're going to record right now legal expense of the amount of that invoice, even though they haven't paid it yet. So they're going to get a deduction for the legal expense. Remember, deductions decrease the partner's basis in the partnership. So the partners are going to have a decrease in their basis for the legal expense that's been accrued. So what this is saying is they then get a corresponding increase in basis for the accounts payable. So they end up at zero change in basis. Basis decreased for the expense, basis increased for the liability associated with the expense. If you're on the cash basis, of course, when the law firm sends you that invoice, you're not recording any expense because you haven't paid for it yet. So you don't have any decrease in the partner's basis due to that legal bill. Therefore, you do not get any increase in basis for that accounts payable. So you are still at zero net effect. So that's the reason we say that accrued expenses and accounts payable do not affect basis for a cash basis partnership. And then the other point about this whole idea of the partners getting basis for their share of the partnership's liability is, again, this is different than an S Corp. With an S Corp, the shareholders do not get basis in their stock for their proportionate share of the corporation's liabilities. So it's another difference between partnerships and S Corps. And it can be an advantage for the partnership because if you're trying to take losses, you can only take losses to the extent you have basis. Therefore, you have a greater opportunity to have basis in the partnership than you do in the S Corp. Now, we'll see when we talk about S Corps that they've actually got two different kinds of basis. They've got stock basis and debt basis. We'll get into all of that when we talk about S Corps. But just know this is a difference between how partnerships and S corps handle liabilities of the entity itself. So let's look at an example here for a partnership. Juan and Teresa form a cash basis general partnership with contributions of $20,000 of cash each, and they share all profits and losses equally. The partnership borrows $60,000 and purchases depreciable business equipment. The debt is included in the partner's basis in the partnership because incurring it creates an additional $60,000 of basis in the partnership's depreciable property. So remember, we had three ways that liabilities could increase basis. One of those was the very first one: if incurring the debt increases the partnership's basis in assets, then it counts. So here they're buying a depreciable asset. So they've got a $60,000 liability on one hand, a $60,000 asset on the other. So the partners get basis for their share of that $60,000. If neither partner has an economic risk of loss in the liability, it is a non recourse liability. In other words, if neither partner is personally guaranteeing the loan, then that is a non recourse liability. So each partner is equally at risk. They've got a $60,000 asset. If they don't pay that loan, the lender can come take that asset away. So each partner's basis in the partnership increases by $30,000 due to that $60,000 loan. If, on the other hand, for example, Teresa personally guaranteed that loan, so if Teresa is required to pay the creditor if the partnership defaults, then she has an economic risk of loss. So her basis in the partnership would be $80,000. So she's going to get the full $60,000 because if the partnership doesn't make the payments, they're going to go to Teresa and say, hey, you need to buck up and pay. So since she is on the hook for the whole $60,000, she gets the whole $60,000 added to her basis in the partnership. Juan gets none of it. So his basis is still $20,000 because that's what he contributed to the partnership, but he does not get any basis in the loan in that instance. So that's the distinction between having one partner on the hook, or not having either partner be on the hook. Losses in excess of outside basis. So as we have said, losses and deductions from the partnership may only be taken by the partners to the extent that they have outside basis in the partnership. Any excess losses are suspended until basis increases enough to cover them. So if you have losses this year greater than your basis, the excess, the amount that's more than your basis, you cannot take that loss this year. But it doesn't mean you can never take them. They are simply suspended until some future date when you do have basis. So maybe next year you have some profits, which gives you basis, then you can take those suspended losses. Or maybe next year you make an additional contribution of capital to the partnership, which gives you basis, and then you can take those losses. But until you do have that increase in basis, those losses are suspended. Also, you need to always keep in mind the at-risk limitations and the passive activity loss limitations. So we talked about those back in video 4. Don't forget about them. You always have to have amounts at risk in order to take losses. And if this is a passive activity for you as the partner, then you've got those passive activity loss limitations as well. So we just don't want to lose sight of that. Well, let's look at an example. C and D form a 50-50 partnership in 2024 by each contributing $25,000 in cash. In 2024, the partnership loses $10,000 for the year. So at the end of last year, at the end of 2024, C and D each have a basis of $20,000. So they contributed $25,000 each. Their share of the loss, the $10,000 loss, is $5,000 each. So they each have a basis of $20,000 at the end of 2024. In 2025, the partnership has a profit of $20,000. In addition, there are Section 179 deductions of $12,000. At the end of 2025, then, C and D each have a basis of $24,000. So it's the $20,000 they started the year with. plus their $10,000 share of the $20,000 in profits in 2025, minus their $6,000 individual share of the $12,000 of Section 179 deduction for the year. Example 2. E and F form a 50-50 partnership in 2024 by each contributing $25,000 in cash. Their partnership loses $40,000 in 2024. So at the end of 2024, they each have a basis of $5,000. The $25,000 they put in minus their $20,000 individual share of the $40,000 in partnership losses. In 2025, the partnership has another loss, this time of $20,000. In addition, there are cash charitable contributions of $6,000. So at the end of 2025, E and F each have a basis of $0. So it's the $5,000 they started the year with, minus their $10,000 share of the $20,000 partnership losses, minus their $3,000 share of the $6,000 of charitable contributions. So that's actually a negative number, but remember, basis can never go below 0. So their basis is now 0, and they can only deduct $5,000 of their loss on their individual 1040s. The other $5,000 of the loss that each of them has and the charitable contributions are suspended until they have a profit or otherwise increase their basis in the partnership. So for the EA exam, you should be able to do simple examples like this. They may test your knowledge of the rules. What increases basis? What decreases basis? They test that knowledge by giving you these kind of simple examples, and you need to figure out, okay, what's their ending basis after all of this happens, and how much can they deduct, and what happens to any amounts they cannot deduct in excess of their basis. So those are the simple examples. Now we're going to get into something that can be a little bit more complicated. This is Section 754 adjustments. The good news is you're not going to be expected to do actual examples of 754 adjustments, but you are going to have to understand the concept of what a 754 adjustment is, why we have it, and what it does. So, when the inside basis and the fair market value of the assets of a partnership are significantly different, tax inequities can occur in certain situations. So, for example, if a partner leaves the partnership and receives a distribution of appreciated assets for their share of that partnership, and that distribution exceeds their basis, the other partners who are still in the partnership can end up having to pay higher taxes on the remaining assets. And we'll show you an example in a little while of how that happens. And a similar disparity arises when a partnership interest is sold or transferred. The new partner can inherit a tax liability for appreciation that they did not participate in. Again, we'll show you an example of that. So when the partnership owns appreciated assets, so they're worth more now than the partnership paid for them. When you have a distribution of assets, or when someone sells their interest in the partnership to a third party, you can have tax inequities that occur. A Section 754 adjustment is used to cure those, to fix those inequities. Now, it can also work the other way. So it could be that the fair market value of the assets is actually now less than their adjusted basis. And you can have a similar problem. You can have some partners who are receiving tax benefits at the expense of other partners. So again, 754 is used to fix that. So in order to fix those things, to address those inequities, the partnership can make what is called a Section 754 election. And what this does is it adjusts the basis of the assets in the partnership to match their fair market value in specific situations. So the primary purpose of a 754 election, this is important, is to align inside basis with outside basis so that all the partners are being treated equally for tax purposes. If the partnership makes this election, it applies anytime either of two things happen. Either property is distributed from the partnership to a partner, or a partnership interest is transferred or sold. Distributions of property are handled under Section 734B. Sales of a partnership interest are handled under Section 743B. So you make a Section 754 election in order to say, yes, we want to use Section 734 and Section 743. The way you make that election is by attaching a statement to the Form 1065 in the year of the qualifying event. Once it is elected, it is going to apply to all future qualifying transactions and cannot be revoked without IRS consent. So that's very important. If you make this election now, you are stuck with the election. The IRS will usually not allow you to revoke this election. Once you make it, you have made it forever. I am going to show you some examples of Section 754. That said, this slide right here will give you the information you need to answer most of the questions you may have on the EA exam about Section 754. The questions are going to be more theoretical in nature rather than actually making you work out a problem. So it's going to be, what is the purpose of a 754 election? Well, it's to align the inside and outside basis so that all the partners are treated equally for tax purposes. If you make the election, it applies to all distributions to a partner under what code section? Code section 734B. It applies to sales of partnership interests under what code section? Section 743B. How do you make a 754 election? By attaching a statement to the Form 1065. Can it be revoked? Only with consent of the Internal Revenue Service. So these are the important things that you want to know for the exam. But in order for us to understand it a little bit better, let's look at some examples. So first, we're going to look at a distribution from the partnership. So this is under 734B. So what happens is if you make a 754 election, again, you are then electing to use Section 734B and Section 743B. Section 734B deals with distributions of property from the partnership. So, example, in 2020, Aaron, Bob, and Charles formed the ABC partnership by contributing $40,000 each, and then they buy two buildings, B1 and B2, for $60,000 apiece. So they put in $120,000 total between the three of them. They bought $120,000 worth of buildings. So their inside basis is $120,000. Their outside basis is $120,000 to start out. In 2025, when each building has a fair market value of $150,000 and the partner's outside basis remains unchanged at $40,000 each, the partnership distributes B1, the first building, to Aaron, who leaves the partnership. Right after that, Bob and Charles then sell B2 for $150,000. So what happens? If they do not have a Section 754 election in place, here's the result. After the distribution of B1, Bob and Charles now own this building, B2, with a $60,000 basis. Now we're ignoring any depreciation or other changes in basis. So it's just trying to simplify the example here. So they've got this building, $60,000 basis, which of course would be $30,000 each. Yet they invested how much in the partnership? They invested $40,000 each in the partnership. So they invested, between the two of them, $80,000 in the partnership. But the only asset that they own has a basis of $60,000. So their inside basis and their outside basis are not aligned. When they sell that building then for $150,000, they have a $90,000 gain. Sales price of $150,000 minus the $60,000 basis, that's a $90,000 gain. They have a $90,000 gain even though they invested $80,000 in the partnership. So really, economically, their gain should only be $70,000. They invested $80,000. They sold the building for $150,000. So their actual gain is only $70,000. But without a 754 election, they have to pay tax on a $90,000 gain. So what happens if they do make a 754 election? Well, then we allow a step up in basis of building 2 to $80,000. So that then aligns it with the $40,000 that Bob and Charles have each invested. So now their inside basis and their outside basis are the same. So when they sell that building, their taxable gain will be $70,000, which is what it should be. So just because of the way the math works, when they distributed that building out to Aaron, the first building, that left them in this weird spot where their inside basis did not match their outside basis. So the 754 election allows them to fix that and to not have to pay tax on a larger gain than they actually experienced economically. So that's 734B, which deals with distributions. Now let's look at 743B, which deals with transfers or sales of a partnership interest. In 2020, Amanda and Beth formed the AB partnership by contributing $250,000 each, and then they buy a building for $500,000. So their outside basis is $500,000, $250,000 each. Their inside basis is $500,000, the amount they paid for the building. In 2025, when the building has a fair market value of $1 million, and the partner's basis, their outside basis, remains $250,000 each, Amanda sells her 50% interest to Carolyn for $500,000. So why can Amanda sell her 50% interest for $500,000? Because the building that the partnership owns is worth $1 million. So Carolyn is buying half of the partnership, so she's willing to pay half of the $1 million. So she pays $500,000 for a 50% interest in the partnership. So if there's no Section 754 election in place, what happens? Carolyn inherits Amanda's share of the inside basis of $250,000. So the partnership's basis in the building is $500,000. Half of that is $250,000. So when Carolyn buys into the partnership, she inherits that $250,000 inside basis of that building. But she paid $500,000 for it. Because the building was worth $1 million, she paid $500,000 for her interest in the partnership. But now her inside basis of that building is only $250,000. So you've got a mismatch here, again, between outside basis and inside basis. Her outside basis is $500,000. Her inside basis is only $250,000. So what does a 754 election do here? It allows a step-up adjustment to the inside basis of $250,000 for Carolyn only. She now effectively has inside basis of $500,000, which is aligned with what she paid. So the result is she gets additional depreciation deductions based on that step up in basis. And when the property is sold, she avoids being taxed on a gain that she did not participate in. So if you think about it, what if as soon as Carolyn bought into the partnership, they didn't make a 754 election, and then they sold that building for $1 million? Well, the partnership's basis in the building was only $500,000. So there's going to be a $500,000 gain. And because Carolyn is a 50% partner, she's going to have to pay tax on $250,000 of that gain. But she didn't actually benefit from the gain. She just bought in. She paid $500,000. But now she's got to pay tax on it as if she only paid $250,000. So that just doesn't seem fair. So what 754 does is it allows her to say, no, my basis in this building is $500,000. So if we immediately sell the building for $1 million, that's a $500,000 gain to me, but I've got $500,000 basis. So now I don't have to pay tax on that, which of course is the fair result. So that's what 754 does. Now, you might ask, why would somebody not elect this? There's an obvious discrepancy here. 754 fixes that discrepancy. Wouldn't you just elect this every time? Well, there's a couple of reasons why you might not. First of all, it could be related parties. You could have a partnership, for instance, where you've got the parents and you've got children, minor children who are in a lower tax bracket. Those parents can actually shift some of the tax burden to their children who are in a lower tax bracket by not making a 754 election, which can save the family tax money overall. So that's one reason. And then another reason why a lot of partnerships don't do it is because it is complicated and it is somewhat administratively difficult to do. When we say here, for example, that Carolyn gets a step up in basis in the building, it's only Carolyn that gets that step up in basis. There's no actual change happening on the balance sheet of the partnership. The partnership paid $500,000 for the building. It's still going to show $500,000 on the balance sheet. But then you have to keep track over here on the side. You have to say, well, yes, it's $500,000 basis as far as the partnership is concerned, but it's really $1 million basis as far as Carolyn is concerned, and that she has half of that. So it's $500,000 for her. So Carolyn has a $500,000 basis in the building. Beth has a $250,000 basis in the building. And you got to keep track of these things separately. And then if you're doing depreciation deductions, the partnership is going to figure their depreciation based on $500,000. But for Carolyn, you got to do a separate computation and figure out depreciation based on $1 million, and then she gets half of that. So you can see it can be complicated. And then once you elect this once, you have to do it every time. So over time, you can have lots of different sales of partnership interests that affect different partners differently. You can have lots of distributions of assets, affects everybody differently. Now you're having to keep track of all of these things on the side. So not only do you have the accounting for the partnership itself, now you're having to do separate accounting for each of the partners in order to keep all of this straight. So a lot of partnerships just say, we don't want to deal with it. So they do not make the 754 election. Again, on the exam, you're not going to have to do these calculations. You're not going to have to worry about the mechanics of how do they do the accounting. None of that is going to be tested. So I want to go back to the other slide where we talked about what's the purpose of 754, what does it accomplish, when is it used, know how to answer those kind of theoretical questions. As we said, Section 754 is an election. You decide whether or not you want to do that, usually. There are times when it's mandatory. This is going to be when the fair market value of the property is less than the adjusted basis of the property. So if you have a distribution where there is a substantial basis reduction, so in other words, instead of appreciated assets, you have assets that are now worth less. If that downward basis adjustment is more than $250,000 when you have a distribution of property, then you have to do this adjustment of basis to the partnership's assets. It is not an election. Similarly, if you have a greater than $250,000 downward adjustment in basis and there is a sale of a partnership interest, then you also have to do this. So just remember, if it's downward, so fair market value is lower than basis and it's more than $250,000, then this is no longer an election. It is mandatory. Next, let's talk about contributions to and distributions from a partnership. As we said, partnerships are typically formed by the partners contributing cash and or other property. And then the partners get basis in the partnership based on their contribution. For cash contributions, their basis is equal to the amount of cash contributed. For property contributions, their basis is equal to the partner's adjusted basis in the property, minus any debts assumed by the other partners. So we'll look at some examples. So this is another case where the IRS loves to talk about what if you give up a piece of property and the person getting the property assumes the mortgage. So if you have a building with a mortgage, you contribute the building to the partnership and the partnership assumes the mortgage. They take over responsibility for the mortgage. Then you're going to want to know how that is handled. They get basis for the property they contribute. So they contribute the building, their adjusted basis in the building. They get basis for that. But if there's any mortgage that's being assumed by the partnership, you decrease the basis to account for that. And then generally, neither the partner nor the partnership recognizes any gain upon the contribution of property to a partnership. And the partnership inherits the adjusted basis and holding period of the partner. So in other words, contributing property to a partnership is not a taxable event. You contribute the property, the partnership steps into the shoes of the partner. They have the same adjusted basis that the partner had. They have the same holding period that the partner had. So if the partner has owned that for more than a year, as soon as the partnership gets it, it is a long-term asset. And they have the same basis that the partner had. So let's look at a couple of examples. Example 1. Ivan acquired a 20% interest in a partnership by contributing property that had an adjusted basis to him of $8,000 and a $4,000 mortgage. The partnership assumed payment of the mortgage. The basis of Ivan's interest, therefore, is $4,800. So it's the $8,000 of adjusted basis of the property minus the part of the mortgage that was assumed by the other partners, which is not the entire mortgage because Ivan is a 20% partner in the partnership. So he still is responsible for 20% of the mortgage, but he's no longer responsible for the other 80%. So 80% of the $4,000 mortgage is $3,200. He's no longer responsible for that. So when we figure out his basis in the partnership, we take the $8,000, which was his basis in the property. We subtract out the $3,200, which is the part of the mortgage for which he is no longer responsible. So his basis in the partnership is $4,800. You will want to know how to do this. This example comes from the IRS publication on partnerships. And again, the IRS loves these examples where the partnership is assuming the mortgage. Example 2, we're dealing with Ivan again. He still acquired a 20% interest in the partnership, and his basis of the property contributed is still $8,000, but now it has a $12,000 mortgage. So now what's his basis in the partnership? Well, it's zero. The adjusted basis of the property he contributed is still $8,000. However, the part of the mortgage assumed by the other partners is $9,600. So it's 80% of the $12,000 mortgage because, again, Ivan is still responsible for the other 20%. So remember, his outside basis cannot go below zero. So his basis in the partnership interest is zero, and then he actually has a capital gain of $1,600. So since he's now off the hook for $9,600 of that $12,000 mortgage, and he only had $8,000 of basis in the property in the first place, he has to pay tax on the $1,600 difference. But his gain does not increase his basis in the partnership. So his basis in the partnership is still $0. Next, let's talk about a disguised sale. In certain circumstances, a partner's contribution of property and subsequent receipt of a distribution from the partnership can be considered a disguised sale. In this case, the partner recognizes gain and the partnership recognizes the purchase of an asset. So, if you contribute, let's say you contribute a building to the partnership and you have an adjusted basis in the building of $50,000, you contribute it, non-taxable, you get basis in the partnership of $50,000. Partnership now has a $50,000 building. Let's say that building has a fair market value of $150,000. That fair market value doesn't affect anybody's basis. The partnership's basis is still $50,000. And again, no tax on the contribution. But let's say 6 months after you contribute that building, the partnership decides to distribute $150,000 of cash to you. The IRS is going to step in and say, oh, no, 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 guys. That was not a tax-free contribution of a building to a partnership. That was a sale of the building to the partnership. You just tried to make it look like a tax-free contribution followed by a distribution of cash from the partnership. But we know what you were really doing. So we're going to force that partner to recognize a gain on the sale of that building. And that gain is computed by the fair market value of the property on the date of the contribution minus the partner's basis at the time of the contribution. When is this going to apply? Well, if the partner contributes property and the partnership makes a distribution of different property, including cash, to the partner, and both of the following are true, then it's going to be considered a disguised sale. First of all, the distribution would not have been made but for the contribution. So if the partner had never contributed the property, the partnership never would have distributed the cash. And secondly, the partner's right to the distribution does not depend on the success of partnership operations. So usually you're getting distributions from a partnership because the partnership has earned profits, and so you're getting your share of the profits. But if they're giving you this distribution, it has nothing at all to do with the profits of the partnership, then that's the second condition that's going to say that that is really a disguised sale. If the contribution and the distribution occur within 2 years of each other, it will be presumed to be a disguised sale, unless the facts and circumstances clearly demonstrate that it was not. So if this happens within 2 years, they're just going to assume that you meet both of these conditions. It is going to be considered a disguised sale. The burden of proof is then going to be on the taxpayer to say, oh, no, 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 it really wasn't. Here's the facts and circumstances that show that it was not actually a disguised sale. So let's do an example. In January of 2025, Barry contributes a building with an adjusted basis of $100,000 and a fair market value of $150,000 to the LND partnership. In November of 2025, the partnership distributes $150,000 of cash to Barry. This will be presumed to be a disguised sale unless Barry and the partnership can clearly demonstrate that it is not. Barry then will report a $50,000 capital gain on his 2025 tax return, and LND's basis in the land will be $150,000. Then we have a similar concept with distributions of contributed property to another partner. If a partner contributes property to a partnership, and then the partnership distributes that property to a different partner within 7 years of the original contribution, the contributing partner must recognize gain or loss on that distribution. The gain or loss is the fair market value minus the contributing partner's adjusted basis at the time of the contribution. So what's this getting at? They don't want people transferring assets from one person to another person using a partnership as the intermediary. So, okay, we'll set up this partnership. I'll contribute the property to the partnership. And then sometime later, you can take the property out of the partnership and now you own it. And by doing that, we can avoid tax on the transfer. The IRS is saying no. If one partner contributes the property, that property is distributed to a different partner within 7 years, we're going to make that first partner pay tax on that as if they sold that building to the other partner. So that's that 7-year rule. Contribution of services. In addition to property, a partner can acquire an interest in partnership capital or profits as compensation for services performed or to be performed. So they can get either a capital interest or a profits interest. A capital interest would give the partner a share in the proceeds if the partnership's assets were sold and the proceeds distributed to the partners. So this is equity. Remember, assets equals liabilities plus equity. You sell all the assets, you pay off the liabilities, the rest of the money goes back to the partners. So that's a capital interest. They are getting ownership in the partnership. And or they could be getting a profits interest. So a profits interest is any interest that is not a capital interest. So for example, an interest in the share of any profits. So here you're not getting and interest in the equity of the partnership itself, you're just going to get a share of any profits that the partnership may earn in the future. If an individual receives a capital interest, an equity interest, in exchange for their services, the fair market value of that interest is a guaranteed payment, and it is taxable income to the partner. So if they say, okay, you're going to work for the partnership in exchange for your efforts, we're going to give you equity interest in the partnership. They can do that. That's perfectly fine. But the value of that equity interest is a guaranteed payment to that partner, and he or she has to pay tax on it. If, on the other hand, the individual receives a profits interest in exchange for the services, it is not a guaranteed payment. It is not taxable. And then you can see some exceptions. But let's think about the reasoning for this. If you get a capital interest, that's got a real value right now. You have an equity interest in the partnership. That has a value that we can quantify. You received that value. You have to pay tax on that value. What about a profits interest? Do we know for sure if this partnership is going to even be profitable? No, we don't. It may never make a penny. So getting a profits interest may not be worth anything. And if it is worth something, we don't know how to quantify it. How much is it worth? So if it's a profits interest, we don't call it a guaranteed payment, and you don't have to pay tax on it. You can see the exceptions. You can read through those. But basically what they're saying is, if it's really not an unknown, so you've got a very predictable stream of income that's coming from this partnership. So we really pretty much do know with a pretty high level of certainty that there are going to be profits, and we can pretty much tell you how much those profits are. Well, in that case, since it's not uncertain, and since we can compute how much it's worth, that will be considered a guaranteed payment. Or if within 2 years of getting that, you dispose of the profits interest, well, then obviously it had some value at the time you got it, and we know how much that value was. And then you've got a profits interest as a limited partner in a publicly traded partnership. Again, that's more predictable, and that is something you can put a value on. So the general rule that you want to remember, though, is if you are getting a capital interest, it is a guaranteed payment. If you are getting a profits interest, it is not a guaranteed payment. And then you'll just remember that there are these exceptions. Distributions from a partnership. So distributions may be made to a partner for a variety of reasons. Could be a distribution of current or prior earnings. Could be a distribution to pay taxes on earnings. Could be a distribution in anticipation of current earnings. Could be a complete or partial liquidation of the partner's interest, or a complete liquidation of the partnership itself. In any case, remember that distributions reduce basis in the partnership, and they also reduce capital accounts. We'll talk about capital accounts later, but capital accounts is the equity in the partnership. So distributions reduce both the partner's outside basis in the partnership and, of course, their equity in the partnership. Distributions of earnings, as we have said, are not taxable per se. Tax is paid on the profits regardless of what is distributed. Distributions of money and marketable securities and things like money in excess of the partner's basis in the partnership are taxable to the partner as a capital gain. So if you've invested a certain amount of money and you get more than that money back out, well, that's a capital gain. So you invested $10,000 in the partnership. Now you're getting a distribution of $15,000 of cash. That's a $5,000 capital gain. If the distribution is property other than money, then usually it's not going to result in a gain until the partner disposes of that property. So they distribute out property other than cash. You're going to get the same adjusted basis that the partnership had. And then once you sell that asset, then you'll pay tax at that time on the gain on the sale of that asset. But you don't have a gain at the time of the distribution of that property. So let's look at an example. The adjusted basis of Joe's partnership interest is $14,000. She receives a distribution of $8,000 in cash and land that has an adjusted basis of $2,000 and a fair market value of $3,000. Because the cash received does not exceed the basis of her partnership interest, Joe does not recognize any gain on the distribution. Any gain on the land will be recognized when she sells or otherwise disposes of it. The distribution decreases the adjusted basis of Joe's partnership interest to $4,000. So it was $14,000, but she got $8,000 of cash. She got $2,000 of land. So now her outside basis is $4,000. So now let's talk specifically about the partner's basis in the distributed property. Unless there is a complete liquidation of a partner's interest, the basis in the property, other than money, distributed to the partner is its adjusted basis to the partnership immediately before the distribution. And then the partner also inherits the partnership's holding period. So this is what we talked about. You get property from the partnership, you're going to inherit the partnership's basis in that property, along with their holding period. However, the basis of the property to the partner cannot be more than the adjusted basis of their interest in the partnership reduced by any money received in the same transaction. So in other words, the basis of the property cannot be more than their outside basis in the partnership reduced by any money received in that same transaction. So let's look at an example. The adjusted basis of Emily's partnership interest is $30,000. She receives a distribution of property that has an adjusted basis of $20,000, and she receives $4,000 in cash. So her basis in that property is $20,000. So she just takes over the partnership's basis in that property. It was $20,000 to the partnership, it's $20,000 to Emily. Example 2. The adjusted basis of Steve's partnership interest is $10,000. He receives a distribution of $4,000 of cash and property that has an adjusted basis to the partnership of $8,000. His basis for the distributed property is limited to $6,000. So normally, he would get the same basis as the partnership. So he would have $8,000. However, his outside basis was only $10,000 to start with. So he had $10,000 of basis. They gave him $4,000 of cash. So that lowers his outside basis to $6,000. So now his basis in that property that was distributed is limited to $6,000. Why is that? Because the property distribution is going to further lower his basis to zero. It can't go below zero. So before the property, take the $10,000 minus the $4,000 in cash, he's only got $6,000 of basis left. So that $8,000 asset is going to reduce his basis to zero. Can't go below zero. So we're going to compensate for that, for the extra $2,000, by making his adjusted basis in the property only $6,000. Again, these examples come from that publication 541. So you will want to make sure that you understand them because remember, IRS uses IRS publications to develop their questions for the exam. So when there are examples given in those publications, it is smart to pay attention to them. Then there is a somewhat new rule, just started in 2024, for distributions of non-cash property. The receiving partner must report the distribution on a new form, Form 7217. It's used to report the adjusted basis of the property that is received. So if you're receiving something other than money or something close to money, like marketable securities, then you have to report that on this 7217. Now let's talk about a disposition of a partnership interest. So when you are selling or otherwise disposing of your interest in a partnership, what happens? Just as with any other asset, a partnership interest can be sold or otherwise disposed of. When that happens, the selling partner has a gain or loss on the sale, and the new partner establishes their basis in the partnership interest. For a sale, the gain or loss is generally going to be considered a capital gain or loss, except any part of the sales price attributable to accounts receivable or inventory is treated as an ordinary gain or loss. So you'll remember that accounts receivable and inventory are not capital assets. They're ordinary assets. So any part of the sale of a partnership interest that is attributable to accounts receivable or inventory, that portion of the sale will be an ordinary gain. Because if the partner had stayed in the partnership, if they hadn't sold their interest, they would have gotten ordinary income from that accounts receivable and that inventory. So when they sell their interest, that portion is ordinary income rather than capital gain. So let's look at a couple of examples. Example 1. Kumar became a limited partner in the ABC partnership by contributing $10,000 in cash on the formation of the partnership. The adjusted basis of his partnership interest at the end of the current year is $20,000, which includes his $15,000 share of partnership liabilities. The partnership has no unrealized receivables or inventory. Kumar then sells his interest in the partnership for $10,000 in cash, and he's already been paid his share of the partnership income for the year. So what happens? Kumar realizes $25,000 from the sale of the partnership interest. So he got $10,000 in cash, but he's also no longer on the hook for $15,000 of partnership liabilities. So he received, in effect, $25,000. So he's going to report a capital gain of $5,000. His adjusted basis was $20,000. He received $25,000. That is a $5,000 capital gain. Again, comes out of publication 541. Pay attention. Example 2. The facts are the same as example 1, except that Kumar withdraws from the partnership when the adjusted basis of his interest in the partnership is 0. So he's not able to sell his partnership interest, so he just withdraws. So you might think, well, that's nothing, right? No, that's not true. He still has gotten off the hook for the $15,000 of liabilities he was responsible for. So he is considered to have received a distribution of $15,000, and so he reports a capital gain of $15,000. So his adjusted basis had gone to 0. He's leaving the partnership. That's a $15,000 benefit. He has to pay tax on that $15,000. If a partnership interest is abandoned or considered worthless, then the loss is considered ordinary as long as both of the following are true. First, the transaction is not a sale or exchange. And secondly, the partner has not received an actual or deemed distribution from the partnership. So what we're talking about here is when business has just gone bad, they're actually going out of business. The partnership has failed. So now the partners are just walking away from this business. They're not getting any distribution. They're not selling it to anybody. It's over. Well, they get to take an ordinary loss for any basis they have remaining in the partnership. So if they had $10,000 outside basis, business is now closed, they walk away, that is a $10,000 ordinary loss. So they can take that loss against their ordinary income. If a partner retires or dies and receives a liquidating distribution, then that will generally be treated as a sale of the partnership interest. And then the result of that is a capital gain or loss. So you're leaving, you're retiring from the partnership, and they're saying, okay, here's your share of the equity in the partnership, and they give you a distribution. Well, it's like you sold that partnership interest. So you're going to look at your outside basis in the partnership, compare it to how much you received. The difference is going to be a capital gain or loss. If the property distributed is not cash, marketable securities, receivables, or inventory, then no loss is going to be recognized. You can have a gain if you're getting that other property, but you cannot have a loss. Then, of course, you'd be inheriting the adjusted basis of the partnership. So once you sell that asset, then you would have a gain or loss. But you don't recognize a loss on the distribution of that property. So when does a partnership terminate? Well, it terminates when all of its operations are discontinued and no part of any business, financial operation, or venture is continued by any of its partners in a partnership. So it could be that one partner is going to continue on as a sole proprietor or as a corporation or something. But if you have, for instance, two partners, one of them leaves the partnership, well, you no longer have a partnership. The partnership terminates. The partnership's tax year ends on the date of termination. which is the date the partnership winds up its affairs. Special rules apply in the case of a merger, consolidation, or division of a partnership. And a short period tax return is filed for the period from the beginning of the tax year through the date of termination. Partnership cancellation of debt. We talked about this in our last video when we talked about deductions, bad debt deductions. But as a reminder, if a partnership terminates and one partner cannot pay his share of partnership liabilities, the other partners may have to pay instead. If they do that and that other partner is insolvent, then they can take a bad debt deduction for the amount of that other partner's debt that they had to pay. Now let's talk about Schedules K, K1, K2, and K3. Schedule K is a summary schedule of all the partners' share of the partnership's income, credits, deductions, etc. So on the 1065 itself, you have a Schedule K, and we'll show it to you here in a minute. But it's going to show for the entire partnership all of their income, all of their expenses, whether they are ordinary business income and expenses or they are separately stated business income and expenses. It will all be shown on Schedule K. Rental activity and income is not reported in the ordinary business income of the partnership on the 1065. Remember, when we looked at the 1065, the income section, rental income was not on there. So it's going to be shown instead on a separate line on Schedule K. Rental income was not in there because rental income is not considered a business, so it's not ordinary business income. So it is reported separately on a separate line on the Schedule K. So let's look at that Schedule K. So you can see here it starts at the top, very first thing, ordinary business income from page 1. So this is the ordinary income and expenses that we looked at earlier. That goes on line 1 of Schedule K. Next, you've got any rental real estate income, goes on line 2. Then you're going to see all of these other things that are shown here, interest income, dividends. Remember, these are all separately stated items. So you're going to go down this whole list. Some of these things are pretty obscure, but they have to be here in case they're needed. And then you can see the rest of the form, all the different things that are shown on the Schedule K. Then the Schedule K is actually continued onto the next page above Schedule L. So we'll look at Schedule L here a little later. That's the balance sheet. But up here at the top, you've got this analysis of net income. So this is the last part of Schedule K. So what this is going to do is total up all the things from the first page. So that includes the ordinary business income, the rental income, all the separately stated items. All of that will be totaled here on the analysis of net income. Then you're going to break that down by the type of partner. So corporate partners, individual partners, etc. This number will be important because later we're going to look at Schedule M1 and M3 when you have to reconcile book income to tax income. Remember, we got all those book to tax differences. Well, when we're talking about taxable income for a partnership, obviously the partnership itself doesn't have taxable income. So what we are reconciling to there is this number. It's the total of all the different income and expense items. Then we've got Schedule K1. So Schedule K shows the entire partnership's income and expense items. Schedule K1 shows each partner's separate share of those amounts from Schedule K. So if you add up all the line items from all of the Schedule K1s, it's going to add up to the amount on Schedule K, because K1s are just distributing out the amounts from Schedule K to the various partners. And then a copy of each K1 is sent to its respective partner so they can use it for filing their tax return. And then each partner should also be sent a copy of the instructions for Schedule K1 so they know what to do with the numbers on that K1. And then a copy of all the K1s are attached to the Form 1065 filed by the partnership. That way, the IRS knows what those partners are supposed to be reporting on their tax returns. So let's look at the K1. So you can see over here on the left, you can have the basic information about the partnership, about the partner. It's going to have information that helps the partner determine their basis in the partnership, like their share of the partnership's liabilities. It's going to do an analysis of their capital account. That's their equity in the partnership. Then over on the right side, we're going to have all those income numbers like we saw on Schedule K. Starts up here. Remember, line 1, ordinary business income. Line 2, net rental income, and so on and so forth. Now, there's not as many lines because some of those more obscure things you can just add up and put in other income or in other information, etc. But it's going to be all the things from Schedule K are going to be reported on Schedule K1. Then we have Schedules K2 and K3. These deal with items of foreign income and expense. So Schedules K2 and K3 are used to report foreign source income and expenses of the partnership. Schedule K2 is an extension of Schedule K, meaning it consolidates all of the amounts for the entire partnership on one form. So Schedule K includes domestic and foreign source income and expenses. Schedule K2 just breaks out the foreign source income and expenses. So it says, okay, of all the amounts reported on Schedule K, here are the amounts that are from foreign sources. So this goes back to the IRS's concern about people not reporting money from foreign sources. So they want to see it. So you use the K2 to show at the partnership level the foreign source income and expenses. Then the K3 is just an extension of the K1, meaning it shows each individual's partner's share of those amounts. So the K3 is going to say for each partner, here is your share of the foreign source income and expenses. Not every partnership has to file the K2 and K3. They're all going to have the Schedule K and the K1. They don't necessarily need the K2 and the K3. So if they meet all of these conditions, they don't have to file K2 and K3. First of all, if the partnership is a domestic partnership, if it's a foreign partnership, they automatically have to file K2 and K3. Secondly, if there is no or very little foreign activity. So if foreign activity is limited to passive income with no more than $300 of foreign taxes paid, and all of that income is reported on a 1099 div, then you don't need the K2 and K3 as long as you meet the rest of these criteria. Next, all the partners are U.S. citizens or resident aliens, or estates, trusts, sole shareholder S corps, or single-member LLCs owned by and or with beneficiaries who are U.S. citizens or resident aliens. So all of the partners have to be one of these. Notice what is not on there. A partnership. If another partnership is a partner in this partnership has to issue Schedules K2 and K3. They have to do that, by the way, even if there is zero foreign source income. They have to show that there is zero. The next criteria is that all partners are notified when they receive their K1 that no K3 is being furnished. So you have to give the partners a chance to speak up. So you have to tell them, hey, we're giving you a K1, but we're not giving you a K3. That way, if one of the partners says, oh, no, I need a K3, they can then go to the partnership and say, hey, I need a K3. Then the partnership has to go back and issue a K3 to everyone. But as long as they notify them, they don't hear back, they don't have to issue the K3 as long as they meet all the criteria. And then lastly, no partner requests a K3. And if they requested one last year, then you have to consider that to be a request for this year as well. Now we'll talk about Schedules L, M1, M2, and M3. On the Form 1065, the last page contains Schedules L, M1, and M2. Schedule L is the balance sheet per books. This is the same across all the entities. Now, Schedule C doesn't have a balance sheet, so you won't have it there. But for partnership, C Corp, S Corp, Schedule L is always the balance sheet. Schedule M1 on the partnership return is a reconciliation of book and tax income for small partnerships. We'll talk about what small means here in a minute. Schedule M2 is an analysis of the capital accounts. So that's the equity section of the balance sheet. So M1 does the book to tax reconciliation of income. M2 is an analysis of the capital accounts. Schedule M3 is not on the 1065. It is a separate schedule, a separate form. It is a reconciliation of book and tax income for large partnerships. So with small partnerships, you do that reconciliation right on the 1065 on Schedule M1. For large partnerships, you're going to use a separate form, the M3. So first, let's look at the Schedule L and the Schedule M1 and M2. So remember at the top, we had the last part of Schedule K. Now we're moving down to Schedule L. So you're going to see, just like we saw in video 2, balance sheet, cash, accounts receivable, etc. Going to have beginning of the year, ending the year. Then you're going to show all your liabilities, all of your capital. That's the balance sheet. Then we're going to move down here to M1. That's the book to tax reconciliation for small partnerships. So we start with the net income per books. Then we're going to show all of the book to tax differences. And we're going to end up with our quote unquote taxable income. That's that amount again from line 1 here on the analysis of net income from Schedule K. So that's Schedule M1. Then you've got Schedule M2. It's just going to look at the capital accounts from the balance sheet. It's going to show the balance at the beginning of the year, any cash contributed, property contributed, net income, any other increases in the capital account, and then distributions and other decreases, and you're going to end up with your end of the year capital account. We'll talk more about capital accounts here at the end of the video. Not every partnership has to file or fill out Schedules L, M1, and M2. What I'm going to call very small partnerships do not have to do that. So, if all 4 of these requirements are met, you don't have to worry about putting a balance sheet or any of this on the tax return. If the partnership has less than $250,000 of gross receipts and they have less than $1 million of total assets, and the return was filed on time and all the partners got their K-1s on time, and the partnership is not filing and is not required to file Schedule M3. So remember, M3 is the reconciliation of book and tax income for large partnerships. So if you are filing that form or you're required to file it, then you also have to file Schedule L and M2. You could leave M1 blank since you're using M3. If you meet this criteria, you're not required to file these schedules, then you have to check the yes box on line 4 of Schedule B. And that's Schedule B of the 1065. It's different than Schedule B of the 1040. So we'll look at that in a minute too. Even if you're not required to complete these schedules, you can still if you want to. I usually like to fill these out for most partnerships, even if I'm not required to, but you don't have to. But if you want to, you're allowed to. So this is the part of Schedule B where you have to check the box. So it's just going over the 4 requirements: less than 250,000 receipts, less than $1 million of assets, etc. Check yes. That lets them know why you're not filing a balance sheet. Now let's talk about Schedule M3. So remember, small partnerships, they reconcile their book and tax income on Schedule M1. Large partnerships, they use M3. So you are required to file a Schedule M3 if any of the following apply. Total assets at the end of the year are $10 million or more. Adjusted total assets for the tax year are $10 million or more. For the exam, just remember it's either total assets or adjusted total assets of $10 million or more. Basically, what adjusted total assets are for a cash basis partnership, you have to do your balance sheet as if you were an accrual basis partnership. So you put on there any accounts receivable. And so if when you do that, that puts you over the $10 million mark, you also have to file a Schedule M3. Then also, if gross receipts for the year are $35 million or more, even if you don't have total assets of $10 million, you still have to file a Schedule M3. And then if any entity partner is itself required to file a Schedule M3 and they own at least 50% interest in this partnership, then this partnership also has to file an M3. So if you've got a large corporation, so corporations are also sometimes required to file M3. So if the corporation is a 50% or more partner and the corporation is required to file M3, then this partnership has to file an M3 as well, even if they don't meet any of the other criteria. And then if the partnership is required to file a Schedule M3, they are also required to file a Schedule C. Again, it's a Schedule C of Form 1065. For partnerships with less than $50 million of assets at the end of the year, they can opt to complete only Part 1 of the Schedule M3 and then to file Schedule M1 instead of Parts 2 and 3 of the M3. So what are we talking about here? If you have a partnership that meets one of those criteria, they have to file an M3, but their total assets are less than $50 million. They don't have to complete the entire M3. We're going to look at it here in a minute. But if they want to, they can just fill out Part 1 of the M3 and then also fill out the M1 back on the 1065. It'll make more sense when we look at it here in a minute. And then if the partnership is not required to fill out Parts 2 and 3 of the M3, they're also not required to fill out Schedule C. And then any partnership who's not required to file Schedule M3, they can go ahead and do so if they want to, but if they do, then they have to follow all the rules and they have to file a Schedule C as well. So let's look at the M3. So this is the first page where we've got Part 1. So you can see some basic information at the top. Then Part 1 is financial information and net income. So this is where you're going to show your book income. So you're going to answer some questions. Then you're going to show your book income. Then you're going to show some asset and liability information. So if you are a partnership with less than $50 million of assets, if you want to, you can just fill out this part, leave the rest of it blank, and fill out M1 on your 1065. Otherwise, you can fill out Parts 2 and 3, or you may be required to fill out Parts 2 and 3. So let's look at those. This is Part 2. So this is where we start our book to tax reconciliation. But Part 2 is reconciling only income items. So you can see how detailed it is. Remember M1, when we looked at M1, it was only a few lines long for the whole form. Here you've got just the income piece is a whole page worth of items. So you can see why a partnership with less than $50 million of assets might say, nah, I don't want to do this. I'll just fill out the first page and then I'll go back and fill out Schedule M1 on the 1065. But if you're required to, then you're going to have to fill out all of this for Part 2. And then Part 3, as you may have guessed, is where we do the reconciliation for expense items. So here we've got the book to tax reconciliation with all the details for each of the expenses. So that's the Schedule M3. Then this is that Schedule C that we said, if you have to fill out the M3, then you got to fill out Schedule C. This is just check boxes. So this is just the IRS kind of fishing for information. So they want to know the answer to all of these questions so they can know if they want to maybe pay a little bit more attention to your partnership. Then our last topic in this video are the miscellaneous partnership topics. We'll start with capital accounts, which we have mentioned a few times. So in addition to basis, outside basis, the partnership keeps track of each partner's equity investment in the partnership. So this is their capital account. Theoretically, the capital account reflects the amount the partner would receive or owe upon liquidation of the partnership. Contributions of property to the partnership are credited to the capital account at their fair market value. Remember, for basis, it's adjusted basis of the property contributed. For capital account purposes, you get credit for the fair market value of the property contributed. Distributions from the partnership decrease the capital account by the amount of cash and the adjusted basis of property. So that's the same as with outside basis. Capital accounts are not affected by partnership liabilities, but capital accounts do increase or decrease with partnership profits and losses. So what we're really looking at is we're trying to compare what happens to capital accounts versus outside basis. And the important thing to know is they are two different things. So your outside basis is not equal to your capital account. So let's look at a little chart here. It kind of recaps everything, makes it easy to visualize. Again, contributions. Got the capital account here, you've got outside basis. Contributions increase your capital account by the fair market value of the property contributed. They increase your outside basis by the adjusted basis of the property contributed. Distributions decrease your capital account and your outside basis by the adjusted basis of the property distributed. Partnership liabilities have no effect on the capital account, but partnership liabilities increase outside basis as the liability increases, and they decrease outside basis as the liability decreases. Then profits increase both capital accounts and outside basis. Losses decrease both capital accounts and outside basis. And then can it be negative? The capital account can be negative. So this represents what the partner would owe upon liquidation. So if you liquidated the partnership, sold all the assets, paid the liabilities, but you weren't able to cover all the liabilities, so the partnership still owed money, the partners would then have to pony up and cover the remaining liabilities. So that would be a negative capital account. They actually owe money upon liquidation. The outside basis, as we said, cannot go below zero. Any distributions in excess of basis are income to the partner, as we discussed. Any losses, when there is no basis, are suspended until such time as there is basis. So kind of understand the differences, know that they're two different things, and understand how these things affect them. Our next topic is the centralized partnership audit regime, or what we typically call BBA. This was enacted by the Bipartisan Budget Act of 2015. What this says is for tax years beginning in 2018, so after 2017, there is what's called a centralized partnership audit regime. In the case of an audit or notice, this allows the IRS to assess and collect tax at the partnership level rather than at the individual partner level. So this was enacted really to help the IRS. So as we said earlier, you can have partnerships with hundreds or even thousands of partners. So imagine the IRS goes in, they audit a partnership, and they find some problems and some adjustments. And they say, okay, the partnership owes X number of dollars as a result of this audit. What they had to do before was maybe the partnership has thousands of partners. They had to send a notice to each partner saying, you owe this much money. So if you are a 0.1% partner of this partnership, you owe 0.1% of the total amount assessed in the audit. So the administrative burden on the IRS is quite high. They got to send notices to all these partners, and then they have to try to collect from each of these partners. So what the BBA came along and said is, no, we're not going to do that anymore. Instead, they're just going to assess the tax at the partnership level. The partnership will pay it. So that's one of the reasons you can have an amount due on your partnership tax return. Now, this can have a negative impact on the partners since the tax that is assessed is at the highest rate. So when the IRS assesses this tax, they do it at 37%. And it doesn't matter who the partners are. It doesn't matter if they're individual partners, corporate partners, whatever. The tax is assessed at 37%, which is the highest individual tax rate. So if you have a partner, let's say you have an individual partner, they're in the 22% tax bracket. Well, now this partnership that they own part of, so part of their assets are being used to pay tax at 37%, even though that partner is only in the 22% tax bracket. So if you did it the old way, where you went to the individual partners, that partner would only have to pay 22% tax. Now, in effect, they're having to pay 37% tax. Also, you could have partners who enter the partnership after the issue at hand took place. So they could end up paying for something that they had nothing to do with. So let's say you buy into a partnership in 2025. The partnership gets audited for its 2022 tax return, and the IRS says, yep, there's an amount due. You have to pay it at the partnership level. Well, now that partner who just bought in, they had nothing to do with 2022. But now they're having to pay tax. Part of their assets is being used to pay tax for something that happened in 2022. So it can be unfair. As a result, certain smaller partnerships can elect out of this centralized partnership audit regime. To be eligible, the partnership has to have 100 or fewer partners. The partners must be either an individual, a C Corp, a foreign entity that would be treated as a C Corp if it were domestic, an S Corp, or an estate of a deceased partner. So if you have, for instance, a trust as one of the partners, you cannot elect out. If you have a partnership that is one of the partners, you cannot elect out. The partners have to be an individual, a C Corp, an S Corp, or the estate of a deceased partner. Also, there must be fewer than 100 K1s issued in total. So for this purpose, the K1s issued by any S Corp that is a partner are added to the K1s issued by the partnership itself. So you may have, let's say, 80 partners. So that's under 100. That's obviously 80 K1s. That's under 100, no problem. But let's say 20 of those 80 partners are S corporations. And those 20 S corporations in total issue 50 K1s. Now you've got 80 K1s from the partnership, 50 K1s from the S corps. That's 130 K1s you do not qualify to elect out of the centralized partnership audit regime. If you do elect out, you have to make the election every year on the Form 1065. So it's not something you do once and don't have to worry about it anymore. You have to elect it each and every year. Partnerships who are subject to the centralized audit regime cannot file an amended Form 1065. So if you have a change and you are subject to BBA, instead of filing a 1065X, you are going to file an administrative adjustment request instead, an AAR. So it does basically the same thing, but it just puts it all in one place. There's no K1s because you're not going to distribute it out to the individual partners. The partnership is going to pay all of it at the partnership level. So we don't use the 1065X. Then the last thing we want to talk about is the partnership representative. Under the centralized partnership audit regime, partners are required to designate a partnership representative. So before BBA, we had something called a tax matters partner. So they replaced that with this partnership representative. And now the representative does not actually have to be a partner. So the tax matters partner had to be one of the partners in the partnership. The partnership representative does not actually have to be a partner in the partnership. That representative has sole authority to act on behalf of the partnership before the IRS, and it must have a substantial presence in the United States and must be designated on Form 1065. And you designate it every year. The partnership representative can be an organization. It does not have to be an individual. However, you still have to name an individual who is the one that the IRS is going to talk to. So, for example, you could have the same organization be the partnership representative every year, but as people come and go, you can change the individual who actually deals with the IRS. And then you're not required to have a partnership representative if you elected out of the centralized partnership audit regime. And that is the end of video 5. A lot of information in there. You may want to watch that again, read and study the slides and the IRS publications. And in our next video, we will discuss C corporations. So I will see you in video 6.